Mr. Farouk Sheikh, you're the Chief Executive Officer for a company called US REO Fund based in New York. Can you explain what the company does?
Sure. US REO Fund basically buys distressed commercial and residential properties in the United States predominantly. There's no geographic focus. We buy in all states nationally. And we only buy from banks and financial institutions and government institutions like Fannie Mae, Freddie Mac, and the FDIC.
So there must be a fair amount of buying distressed real estate going on at the moment.
You know, there's a lot of, the word distress is a big buzzword in the States, and there's a lot of capital that's been readied and sitting on the sidelines. Most of the distressed transactions have either happened in non-performing notes, but in terms of actual assets, most assets that have sold so far are residential. A lot of the commercial that people have been waiting for are starting to trickle into the market, and I think we're going to see a lot more commercial assets, distressed commercial assets for sale either in Q4 of this year through 2011 and 2012 and onwards. Okay.
You mentioned the company has a unique method to help people own homes. Can you tell me more about that?
Well, yeah, I mean, a couple of years ago, while we were waiting, ourselves waiting on the sidelines to buy commercial distressed properties, we came across an opportunity to buy lower-end homes across the U.S., again, from banks and financial institutions. And there's one specific bank had houses, typically under $30,000, $40,000 for sale. These were houses that were historically mortgaged for anywhere from $80,000 to $200,000. And we were not interested in owning multiple assets or multiple homes in multiple cities, multiple states, and being a landlord. It's just not a practical business model. And so what we tried to create was a structure where we were more like a bank. And what we came up with is basically buying these homes and selling them back to homeowners where we provided the financing. So very similar to seller financing. And the important thing about this model is when we started it, it was really more of a social experiment to see if we could create affordable home ownership where it was cheaper for people to own their house than to rent the house next door, an identical house next door. So for example, in a market, if the rents are, say, $700 for a 3-bedroom house, historically, somebody would be paying an $850 mortgage on that house with taxes and insurance. With one of our properties, where the rents are $700, their total cost of home ownership would be maybe $500, paying us $350 and $150 in taxes and insurance. So we created a system where it was a win for the homeowner, and it made sense for them to go into home ownership as opposed to rentals.
So how can investors benefit from this?
Well, I mean, in the old days, banks used to create mortgages or provide financing, and they'd securitize their mortgages, and maybe somebody in Norway would be buying a small piece of a house in Ohio and in some other state. What we've done is we've actually, we acquire about 50 to 80 assets a month, 50 to 80 houses a month from various banks. About 3/4 of those get sold to homeowners, and at some point we needed to create liquidity for ourselves because we didn't have a bottomless pit of capital. So we sell our already sold homes to investors such that the investors make about a 15, 16, 17% return based on annual cash flow. So our investors typically make 15 to 17% for 15 years, or if the homeowner refinances, then they'll make a higher return in a shorter period of time.